Hello, everyone. Good morning, a good afternoon, or a good evening from my side, depending on where you are around the world, and welcome to this IAIS panel discussion on the Global Monitoring Exercise, also called GME. My name is Dieter Hendricks, and I'm the chair of the Macroprudential Committee of IAIS, and I will try to guide you through our panel discussion today. Now, to kick off, allow me to give you a brief overview of what to expect. To start and introduce our panel discussion, we will open with an overview of the main conclusions of this year's global monitoring exercise. As you know, the GME is used by the IAIS to analyze and detect the main trends and risk of the global insurance sector, as well as to detect and potentially mitigate any potential buildup of systemic risk. This year, we conducted the first fully fledged global monitoring exercise, and I'm happy we can share and discuss some of the main outcomes with you today. As such, during our panel discussions, we intend to focus on the main trends and developments which we identified and covered in this year's global monitoring exercise. Our discussions will therefore zoom in on the different aspects and outcomes of our global monitoring exercise. In a first round, we will discuss the general scene. This is the general macroeconomic environment insurers have to operate in. Next, we will discuss the challenges for insurers linked with the low and possibly changing interest rate environment. Afterwards, we will move to a discussion on how these challenges are leading to a changing life in insurance industry and how they could impact insurers' business models more generally. We will end our panel discussions today with a last round focusing on the impact of some, I should say, hot topic emerging risks such as climate and cyber risk. Now, when I say we, I'm happy also to introduce to you already my fellow panelists of today. First of all, we have Bernie Birnbaum, Executive Director at the Center for Economic Justice. We also have Frank Rund, Chief Executive Director of Insurance and Pension Fund Supervision at BaFin. We have Michael McRae, Vice Chair of Brookfield Insurance Solutions, and Stefan Holzberger, Chief Rating Officer at AM Best. I'm looking forward to having an undoubtedly interesting series of panel discussion with this distinguished list of panelists. After our regular round of panel discussions, I hope we will have some time left to cover also questions from you, the audience. And for that, I will invite you to use the chat function, which you should have available in your WebEx. So in case you have a GME-related question which you would like us to discuss, do not hesitate to use this opportunity. Now, as highlighted before, to start, I would like to pass the floor first to Nicola Kolpaert from the IAIS Secretariat, who will provide us with an update of the main outcome of the global monitoring exercise this year as an introduction to our panel discussion. So please, Nicola, go ahead.
So, hello, Dieter, and hello, everyone. So, as you say, Dieter, this year, for the first time, we have completed the GME as designed within the holistic framework, after a year where we repurposed the exercise to perform a targeted assessment of the impact of COVID-19. The GME builds on in-depth data analysis of two data collections. The first is the individual insurer monitoring data collection, to which approximately 60 of the largest international insurance groups participate. And the second is the sector-wide monitoring data collection, to which approximately 30 of the largest jurisdictions participate, covering over 90% of global gross written premiums. We would like to make use of this opportunity to thank participating insurers and jurisdictions for the contributions and for the continued engagement in the GME, which ensures the global coordination of supervisory responses is grounded in evidence. The IAIS held collective discussions on the outcome of the GME, focusing on the one hand on individual insurers that demonstrated increases in systemic risk scores, as well as on the other hand on three macroprudential risk themes which were identified as supervisory priorities. And to set the scene for this panel, I will briefly zoom into the GME highlights of each of the three macroprudential themes. The first theme is the low interest rate environment and the related trend of private equity ownership of insurance business in some jurisdictions. Following unprecedented monetary policy interventions, interest rates remain low and continue to impact insurers' profitability and solvency. Most impacted are life insurers that hold large amounts of long-term liabilities, often with guaranteed returns, as low interest rates not only increase their liabilities, but also decrease investment income. Some supervisors note, in particular, the challenge for insurers to find adequate assets to maintain their asset liability matching, without taking on significantly higher risk. In response to the low interest rate environment, insurers are also changing their business models. In particular, the life insurers have implemented changes in product mix, for example, reducing guaranteed rates and shifting towards biometric risk and unit-linked products. And other examples of measures are reviews of the asset allocation, a related investment strategy, decreasing discretionary profit sharing to policyholders and dividends towards shareholders, and increasing mergers and acquisitions, leading to sectoral consolidation. Relatedly, the private equity industry is increasingly acquiring insurance business in certain jurisdictions as they seek steady capital inflows into their fund offerings. And this is one of the trends we will also touch upon in the panel today. The second macroprudential theme is credit risk. Sovereign and corporate debt reached historically high levels, which could lead to credit spreads widening, defaults, and rating changes. Most insurers are assessed to not be taking on excessive credit risk with high average credit quality of assets. However, some insurers are changing their asset allocation in search for yield, for instance, towards certain alternative investments, leading to increased credit risk. Insurers, as substantial fixed income investors, manage credit risk, for instance, through concentration limits. Furthermore, supervisory stress tests and ORSAT reports include detailed information on the impact and management of credit risk should certain adverse scenarios materialize. The third theme is cyber risk. Cyber risk may result in data breaches, discontinuity of operations, and financial or reputational risk. Supervisors are mindful of the increased frequency and severity of cyber attacks. Furthermore, the shift to remote working and increased digitalization combined with the rise of new technologies further increases cyber risk going forward. A key vulnerability is the growing dependency on third parties, with a small number of critical service providers presenting increased concentration risk. Cyber attacks targeted at common exposures to, for instance, cloud service providers may have a system-wide impact in case of dysfunction. Insurers are increasingly embedding cyber risk in their top-level governance and risk management. Cybersecurity strategies are implemented, consisting of security testing, incident response, and business continuity planning. Cyber maturity level assessments are increasingly incorporated into supervisory risk scorings. Cyber risk may also impact insurers' liabilities, not only through explicit cyber insurance underwriting, but also through non-affirmative cyber risk exposure, which can be limited through cyber exclusion clauses. Data on cyber exposures of insurers is limited, while data on accumulation risk related to cyber underwriting is even less available, posing challenges for cyber insurance pricing and reserving, warranting conservative underwriting. At the panel today, we will touch on these challenges around cyber risk, which, in addition to climate risk, is one of the key emerging risks facing the global insurance sector. Dieter, that concludes my overview of some of the GME highlights. More details will be disclosed in our GMAR later this month. And with that, back to you to dive into the panel discussions.
Thank you very much, Nicola, for setting the scene for us. And allow me to welcome again my fellow panelists. Now, for those of you that have assisted also yesterday's panel discussion, you know we also have a new feature in which we also ask for the opinion of the audience through a polling system. So before I start the first round of questions for my panelists, I would like to initiate a first poll to gather the input of the audience, input which we will be able to use during our later round of discussions. So can I ask to pop up the first poll? So I'm going to just read it out loud. What is your expectation as audience on the path of the interest rates over the next 1 to 3 years in the developed economies, taking into account items such as maybe inflation, monetary policy stance, etc. Do you expect the low interest rate environment to continue and to be stable? Do you expect that it could get worse for insurers and deepen? Or do you, on the other hand, expect that interest rates would increase? And in case you would expect that, my question for you would be whether you expect a gradual increase or rather a rapid increase of interest rates. So feel free to vote. You only have one choice, so I would ask you to vote for the option that feels closest to your heart. Now, while the audience will answer this question, let us start with the first round of the panel discussion, the general economic environment. And my first question here, maybe for you, Stefan, is what macroeconomic trends are, according to you, influencing the strategic decisions of insurers?
The commentary that set us off was really right on point. I think a lot of the topics that I would point to in terms of those macro trends that are most meaningful to the life segment were touched upon. One of the key points I feel is we're really in an environment of uncertainty, right? Whether it's the path of COVID over the next 6 to 12 months, whether it's the potential for increased economic and financial market volatility, and not to mention the path that interest rates will take, as well as inflation. So the high degree of uncertainty overall, I would say, really is a significant challenge to the life segment. Prolonged low interest rates, as we see in the market today, is nothing new. They've been around for years, decades really, and what that leads to is spread compression, which I know we're going to get to in the panel discussion today. Certainly a major challenge for life insurers from an earnings standpoint, and for many also in terms of capitalization. In the current environment, investors are really not getting an appropriate return for the risks that they're undertaking. So as investors, life companies, are really challenged to balance that risk return relationship when the returns are anemic at best across various asset classes. In addition to that, we now see very present signs of inflationary conditions, tied to supply chain disruptions, which are in the news and reported about on a daily basis. You've also got very high energy prices, low unemployment in certain markets, increasing costs of labor, not to mention stimulus and infrastructure spending in certain markets. So the inflationary conditions are absolutely alive and well in the market today. Whether they're transient or not is open to debate, but it is certainly something that all businesses and industries will have to contend with over the near term at the very least. We also see a huge amount of capital looking to enter the market. I think that was touched upon as well in the introductory comments. We see conditions that are very hot for M&A, block acquisitions. There's a real interest in this segment of the market, and there are a lot of players looking to build up size and scale and really get into the market in a meaningful way. So I think really kind of boiling that down for AM Best, what does that mean? What do we talk about with our insurance clients? A lot of it comes back to enterprise risk management. And I think it's probably a theme that I'll touch upon a few times during our discussion today. It's incredibly critical in a market with so much uncertainty and the potential for so much volatility for these ERM programs to be dynamic and enable the insurance organizations to identify these trends, these changing conditions, and react quickly.
Thank you very much, Stefan. I hear a high degree of uncertainty, spread compression, inflationary pressure, hot M&A activity. I would say exciting, though turbulent times for insurers. Now, maybe Michael, I guess you would maybe like to add your perspective on this. Anything else other than what Stefan is saying, or are you more or less in line with what we have heard so far?
Dieter, thank you. And let me start by saying it's great to be here, great to join you, great to join Frank Grund and the other members of the panel to support another important IAIS discussion. My comments today are going to be general, not specific to any one institution. But let me start by saying I do generally agree with and support what Nicholas's characterization, Stefan's characterization as well. I would add a couple other thoughts, though, a couple other perspectives. First of all, yes, low interest rates, macroeconomic condition, one that we've talked about for years at this point. But there's this these other elements that are less macroeconomic, but definitely macro level considerations. One is for publicly traded firms, we see more shareholders interested in asking the question, are these insurers using their capital in the most efficient way? Are these capital intensive products the best use of capital for this company? Or is there a better way to deploy that capital? We've seen that in the United States and in other places as well. So we see insurers asking in the context of low interest rates, are there, is the yield in the investment portfolio sufficient not only to meet existing policyholder obligations, but to make new products attractive? So it's not just supporting existing business, it's supporting potential organic growth as we go forward. And then let me touch real briefly on this notion of what has been labeled private equity. Private equity, when I started, well, this goes back now many years to when I was at the NAIC and in the state of Illinois, and we saw some firms that were conventional private equity firms get into the insurance space. Really, that term is potentially misleading. These are alternative asset management firms, firms with fund offerings that are extremely long dated, multi-decade in duration, and alignment across an investment platform with a policyholder interest. So it's not private capital coming into the space for a 2 to 5 year commitment. It's asset management firms that see those long duration liabilities as matching perfectly with their long dated assets. And the final comment, Dieter, to put some perspective on that, we've seen overall a trend away from public markets. More and more capital is in the private market. So for example, in the EU, I think we have 30% fewer public companies today than we did just 10, 12 years ago. In the United States, it's 45% fewer public companies than we had 25 years ago. So the private markets are right now roughly 8 trillion in total capital, expected to be closer to 13 trillion in the next few years. So those are, in addition to technology, demographic changes, those are a few of the macro level considerations that we see affecting the sector, not only today, but in the years to come.
Thank you very much, Michael. And I've noted down a few interesting points at the trend away from the public markets. Your thought-provoking questions: are insurers putting their capital in the right place? So, and the private equity ownership, which, by the way, we'll come back to that in more detail during a later part of our panel discussion. Now, maybe let us move to Frank to get also a supervisory perspective on this debate. Frank, if you look at the trends, what risks do you see? Which emerging risk, which systemic risks could be there on the horizon in scope for the insurance sector? What's your view?
Hello, everybody. I think we got a very good impression from the speakers before me about trends, and I agree in general with their opinions. I think the global monitoring exercise has shown that the insurance sector as a whole navigated quite well through the COVID pandemic so far, and that I can also confirm from a German perspective. But we have to see how the recovery will continue, and I see five trends. I think not new, we heard it already, is, I think, low interest rate environment, especially for the life insurance business. That is really a challenge, and I understand that we have opportunities to discuss that further. Then I see a clear trend all around cyber risks, especially operational resilience. The more insurers and also ourselves and supervisors rely on digital technologies for the day-to-day work, the more we need to make sure that sufficient safeguards are in place. the accelerated digitalization also leads to a growing demand for cyber insurance that can be seen as an opportunity, and I see it more as a risk and a challenge for insurers and for reinsurers. I think that needs monitoring, and monitoring needs as well how the companies are managing all the current expectations on climate policy, climate change. The NatCat claims are interesting. The whole change on the asset side, so all around sustainability is the fourth trend. And the fifth trend, and that is perhaps a good way to ask Bernie, that I think around the jurisdictions, a clear trend for a few years now, the rising awareness of consumer protection and the necessity for supervisors to make sure that customers are treated fairly. So that is a starting point, my 5 trends. Thank you.
Thank you very much, Frank, for summarizing to us these trends, and you perfectly linked to my next question, which is a question indeed for Bernie. Bernie, what trends do you see driving the change in the insurance sector? And of course, I would be particularly interested in your view on how do these trends potentially impact consumers? If you can give us your thoughts on that.
Well, you're in luck. I, in fact, can give you my thoughts on that. Thank you. And thank you for your kind introduction. And thank you to the IAIS for inviting me, a consumer stakeholder, to participate in this session. We greatly support the global marketing exercise and believe that that type of market surveillance is critical for consumer protection and financial stability. So continue to do this work and improve it along the way. The GME has identified a number of issues, so I'm going to focus initially on trends that are impacted directly or indirectly by low interest rates, because I know we'll get to some of the others. And of course, my experience is largely based in the US, but what we've seen are some exacerbations of longer-term trends. So in the US, there's a long-term trend of fewer people buying life insurance despite population increases. So the percentage of people with life insurance is much smaller than it was 10 or 20 years ago. We also have a long-term trend of businesses shifting away from pensions to retirement accounts, shifting the risk from the business to the workers through 401ks and IRAs. We see the companies with pensions purchasing annuities to shift the business pension risk to insurers. And we've seen the insurer product mix change dramatically over the years, with insurers shifting away from pure protection products towards investment type products aimed at more affluent consumers and away from guaranteed products with interest rate risk. In the long-term care space, we see radical product changes and a movement towards combination products, life long-term care, annuity long-term care products. And of course, we've also seen catastrophic failure in the standalone long-term care market in the US. We see insurers disposing of blocks of business through reinsurance, business transfers, and sales to free up capital and dispose of lower profitability products. So all of this to say that the pandemic and the movement of private equity into the life insurance space has been around for a while, but it's accelerated because of the pandemic, and it continues those trends. And there are several aspects of this that cause great concern for consumers and are concerned about financial stability. I won't get into all of them in these introductory comments, but the main one is the shifting of risk from the insurer to the consumer in the absence of product guarantees. life insurance products and many annuity products are becoming more like pure investments than insurance, with profound implications for consumers' retirement security. And the other aspect of that I want to touch on that's of great concern is the nature of sales of these highly complex investment type life insurance and annuity products. In the US, they might be indexed universal life, fixed indexed annuities, registered index linked annuities, securities, for example. And the way that insurers sell these products, the primary tool is called an illustration. And an illustration is a lengthy document with tables of projected accumulation values, how much the consumer is supposed to see the value of their investments in this life insurance or annuity accumulate over time. And this illustration of projected accumulation values is unique to insurance. No such illustrations are permitted with the sale of other types of investment products because they're highly speculative in nature. The principal method of competition to sell these investment type life insurance and annuities is to design products which maximize the illustrated value. The products are designed for purposes of illustration as opposed to actually meeting consumer needs. So what we've seen are insurers data mining historical investment results to devise custom indexes in collaboration with investment banks for products that show unrealistic illustrated accumulation values. And while US regulators have taken some modest steps, in general, the regulators have declined to take action to address the consumer protection issues associated with these illustrations. And in the limited instances in which the regulators have taken steps, the insurers have quickly developed new product designs to evade the intent of the regulator efforts and to continue to provide unrealistic illustrations. And it's critical to point out that this type of competition drives out the good players. The insurers who want to present their products fairly lose market share to those insurers who are willing to offer these unrealistic illustrations. So I know I've gone on at length, and I'll sort of stop there, but this has disturbing parallels to the causes of the financial crisis in 2008 and 2009. So I'll leave it at that. But thank you again for inviting me to participate.
Thank you, Bernie, for that perspective. I know that how the macroeconomic environment does prompt insurers to change or alter their product mix, also a move away from guarantees. I think that it was also something that we observed during our global monitoring exercise, and I noted down your point of attention, at least on some of the sales and distribution strategies being followed by certain insurers. Now, I think it's time to move naturally to one of our next key topics, which is the low interest rate environment. And before doing that, I would like to check if we can have the results of our first polling question in the meanwhile. So I would ask to pop up these results. Yes, we have them here. These are very interesting. So I see that a majority of our audience does believe that we are heading towards increasing interest rates, and to be more specifically, gradually increasing interest rates. Though there is still a large part of the audience that feels that we could still be heading for a prolonged, even more prolonged low interest rate environment, and a very small minority that would highlight that it could go even deeper, the interest rates, as where we are today. I think that's an interesting background information for our next round of questions. In the meanwhile, I would also ask the audience to take a look at the second poll we are initiating today. So this poll is focusing on what would you expect insurers to do if low interest rates continue. So imagine that the low interest rates would continue over the next 1 to 3 years. What which type of action would you expect insurers to take? No actions at all? Do you expect an increased search for yield? Do you expect other changes to business models, like the change to the insurance product mix? Or do you expect insurers to increase their efforts to optimize their operational efficiency, or maybe any other action? So I would ask the audience to also complete this poll. We will use it again as an input for our future discussions, and I would warmly welcome everyone to participate. The more people participate, the higher the representativeness of the results of our poll. Now, moving on to discuss a little bit in more detail the impact of the interest rate environment of insurers. And Michael, I'm turning first back to you. We've heard it today already. I think it was Stefan mentioning the yield pressure, the pressures on the spreads. Is it possible for insurers to still earn a decent rate on their investments? What search for yield pressures do you see insurers facing, and how do you see them addressing these challenges, and what related risks do you see?
Peter, of course, the answer to those questions to a great extent depends on the insurance company itself, and there are vast differences among the companies. But generally speaking, I think it's fair to say that the search for yield and the importance of portfolio performance, this is not new. In the life sector in particular, that's an essential part of the business, and that's been the case since the start of the industry. What is new is this prolonged period of low rates, as well as a number of other macro level conditions, some which we identified already. The challenge is, of course, as former supervisor, but also from my current spot, the concern is, the pressure of portfolio performance, is it affecting the capacity to meet existing policyholder obligations? First and foremost, seminal question. Secondly, organic growth. If the company is active in a market, are its products competitive if it's not producing adequate yield relative to its peers who are also competing in that same market? Thirdly, the efficient use of capital. Because of the pressure on the investment portfolios, shareholders and insurers are asking whether long duration capital intensive liabilities are the best use of capital in this environment. And should that capital be shifted elsewhere? And we've seen that with a number of multinational companies moving from developed markets, developed economies, into developing markets that are viewed as largely more profitable or more likely to be profitable than some of the developed markets. So as a result of variety of issues, pressures, constraints, the insurers are looking at a range of options, reinsurance, innovative reinsurance structures that can, like modified co-insurance, for example, that allow supervisors of the primary insurer to retain oversight over the assets of that reinsurance associated with that reinsurance transaction. There are portfolio transfers, the sale of blocks, sale of licensed and operating companies in different jurisdictions, and also the repositioning of investment portfolios with through arrangements with alternative asset managers going into the massive private credit market, real estate, other long duration assets, and that can produce additional uptick in yield, but also preserve the appropriate risk profile in the investment portfolio that works for that insurance company and works for the supervisors. Now, addressing the last part of your question, what risk does this pose? I think that the supervisory community, by and large, and the industry are aligned, and I would say aligned with most aspects of the asset management industry in that there cannot be a misalignment of interests. The investment portfolio, the capital management decisions at the company level, these all have to be align with the interests of the policyholder first and foremost. And we see that through strategies to maintain and enhance asset liability matching, enhanced governance. Some of us spent many years working on ComFrame, and we see implementation of ComFrame with this enhanced governance over the investment aspects of an insurance company. I'll stop there, Dieter, but those are a few thoughts in reaction to your question.
Thank you for that, Michael. I hear you saying, thinking about where to invest, thinking about innovative structures, thinking about are my products still competitive in this environment? All interesting questions, I think, which insurers are struggling with these days. Now, Frank, moving again to you, from a supervisory perspective, what risks do you see for insurers with a continued low for long environment? And have you seen supervisory requirements evolve over time in that sense, or do you expect that maybe to change?
I think it's clear we see an ever growing pressure on insurers to earn sufficiently to cover the guarantees given to policyholders. In the past, I would say, we have to distinguish between the past and new and future business. But it's a matter of fact that specifically in long-term life insurance contracts, we had high guarantees, and from today's perspective to high guarantees, and that's obviously a challenge. And as a supervisor, I would clearly agree with the poll participants who say we have to be careful and let's not hope for growing interest rates. Yeah. I think as a prudent supervisor, we are assuming that the low, or in Germany even negative, interest rate environment will last some time. So that needs attention from supervisors, and I see it's twofold more or less. Obviously, insurers are increasing their risks and their investments in order to earn some additional basis points. You can call that search for yield, and I think we have to distinguish between unreasonable and reasonable search for yield. And that is our job as supervisors. We have to make sure, on the one hand, to monitor this closely, and on the other hand, to make sure that the risk is taken into account in the ERM framework, or in Solvency II, what we say in the ORSA, which own risk assessment and so on, and better governance and prudent person principle, etc. But Mike and I might add, I would like to add that also in the capital requirements, that has to be mirrored in the capital requirements, for example, like it is in a risk and market-based solvency regime like Solvency II. And the new part of the business, there I think the world already has changed, because products are changing, and traditional guarantees are replaced by new products that shift investments and the risks of investments to the policyholders. And that is not per se bad, because I think there are more chances for the policyholders to earn a decent yield. They can benefit from a more efficient investment process through expertise of an international investor or institutional investor, as well as more investment and profit opportunities. But obviously, and I totally agree with Bernie, that brings additional conduct risks and which we have to supervise. Insofar, supervisors have to react on that. I already mentioned the capital system, the Solvency II. That is a reaction to this development. And I hope that we will make a progress on a global level as well with the ICS. That's exactly one of the key questions there. And in our local gap, and other countries did it as well, we made some amendments, reduced the guarantee rate companies are allowed to to guarantee all that we asked them to by law to increase their technical provisions. What I think, and then I will close, we have to make sure that the market is transparent for the customer. And I totally agree with Bernie. We cannot allow suppliers or insurers to give unrealistic expectations to the customers. I think that is one point. But for me, even more important is that there are too many costs in the system, and we have to reduce a too high reduction in yield for the customers. I think there are still the cost burden is in some cases too high, and I think that needs supervisory action. I will stop here.
Thank you, Frank. So work on the plate for the supervisors in terms of system of capital requirements and in terms of supervising conduct risk, I would say. Now, I'd liked very much your quote, let us, at least as supervisors, not hope for increasing interest rates. Nevertheless, Stefan, we saw in our poll that we conducted with the audience that there is quite a proportion of the audience that do believe that interest rates may be heading for a reversal, be it or not, due to the pressure that we feel from inflation. What key risks do you see for insurers in case we would be heading for such an interest rate reversal scenario?
Right, thanks, Dieter. So yeah, interesting polling results without a doubt. And I think from our clientele at AM Best, kind of looking across the life segment, more of our US clients, I think, would predict a steady increase in interest rates. And in contrast to that, our European clients, life insurance clients, are more in the camp of that continued low interest rate environment and the challenges associated with that. So, there are different paths that rising interest rates can take, and that can be very meaningful to the life segment. A slow, steady increase in interest rates would provide some relief to that spread compression, which I mentioned. I know that, in Germany, the rising Zinszusatzreserve is an issue, particularly for the smaller or medium-sized mutual life companies that may not have the same kind of financial flexibility as the larger players in the market. So, a slow, steady rise in interest rates could be managed through kind of product adjustments. It wouldn't necessarily lead to a shock to the investment portfolio, and decisions could be made in a measured way. I think what would be most alarming to the segment would be a spike in interest rates, right, which could lead to a view from policyholders that the policies that they maintain are no longer competitive, and that could lead to, worst case scenario, kind of a run on the bank where policyholders are shedding their savings products and looking for alternatives, whether they be through bank products, other life insurance products, or mutual funds in some markets. So, that's really the biggest risk to the segment as we see it, from a spike in interest rates. And, those surrenders would lead to a call on capital. Life insurers would have to free up investments and have the cash on hand to support those surrenders, perhaps at a time when valuations were underwater. So, it's certainly a challenge in that sort of scenario. In the United States, many products have surrender protection, so there are some penalties for abruptly canceling a policy. Those protections are really not in place in the European markets, at least not to the same extent. They operate more akin to a CD, where you might lose a year's interest, but if you can transfer your cash to a much better yielding investment option, that lost interest for a relatively short period is probably not going to protect the life segment from that kind of disintermediation. So, what do we see? Clearly, regardless of the path that interest rates take, asset liability matching is key. Again, in the United States, it's a challenge. You have very long dated liabilities, and it becomes very difficult, investing in 10-year treasuries or other asset classes to match those long tail liabilities. And as we know, in Europe, the name of the game is investing in long dated sovereign debt to match those long-term liabilities. You get some capital relief in that scenario where under Solvency II, sovereign debt is treated as risk-free. So there's an additional incentive there to match those liabilities with sovereign debt. But again, what kind of yield are the companies really able to get from those matched assets? So, really kind of back to what I was mentioning before, the key for the life segment is really kind of that ability to adjust the products under changing conditions, make sure that they remain competitive as best they can, and also make adjustments to the investment portfolio to achieve that risk return reward. I think my last comment on that would be, I think just to reiterate what Michael said about that shift to less capital intensive products on the life side. I think that's definitely something we're seeing across most of the markets, and really kind of shifting that emphasis towards unit linked, biometric protection type products, as well as fee generating products. And we expect that trend to continue.
Okay, thank you very much, Stefan. I know that your ALM is key. That's indeed the core, I would say, also of the business model of the insurers, and making sure that the assets and liabilities are adequately matched. And yeah, as you mentioned, a steadily increasing interest rate environment would of course be far more preferential than having an interest rate spike, which could indeed lead to a situation where policyholders may seek to lapse. Now, moving steadily on to the next part of our panel discussions. So, having experienced this low interest rate environment, and I know that several of you have already highlighted how this impacts insurers in many different ways, how this impacts the business models. I think Michael mentioned it already. We see also a trend of private equity ownership, which brings both benefits and risks. But before moving on to this next panel, I would like also to ask whether we can see in the meanwhile the results of our second poll. So let me just wait for a few seconds. Here we are. I see here quite a divided audience in terms of whether we would expect insurers to increase their search for yield and corresponding investment behavior or asset allocation on the one hand, and part of the audience, both around 40%, which expects rather the business models and the insurance product mix to change. Of course, everyone was only obliged to choose one option. I could imagine that even within the audience, people would also rather expect a mix of these things to happen. I'm going to use that opportunity to also launch our third and last polling question. And this polling question actually is very much linked to one of the themes which was also highlighted in the global monitoring exercise. I'm just waiting a sec so to make sure that it pops up for the audience. Just check, could we have... All right, we have it here. Thank you very much. So we've talked about private equity participation. So what impact does the audience feel an increased private equity participation could have on the insurance sector? Do you expect that this maybe doesn't bring any important changes for the insurance sector as a whole? Do you think this could lead to an increased focus on efficiency and capital optimization, or rather an increased investment allocation to riskier assets, for instance, or something else? So I would be happy to gather the view of the audience also for this question, and hopefully we'll be able to use that input during our next round of debate. So for our next round, let me first turn again to you, Bernie. We've seen and several speakers have highlighted the different possible changes that could happen to insurers' business models. And my question to you is, you've already highlighted some of the dangers that you see there. how do you see that these changing business models, how do you see that potentially private equity ownership could impact the consumers? Do you see additional risks in that respect or not? Could I just check? Sorry, Bernie, I see that you're muted.
My apologies. Thank you. Yeah, we do have concern about sort of private equity's move into life insurance, but I did want to mention something briefly about sort of the low interest rates and sort of a supervisory issue that we think is important, which is when insurers reserve for their products that have guarantees, they have to project what the interest rates are going to be into the future. And if those interest rate projections are on target, they may have to take losses now. And so there's an incentive for insurers to perhaps overstate the future interest rate environment in order to avoid sort of taking losses or write-downs on their guaranteed products. So that's definitely an issue that we suggest for supervisors to look at. In terms of private equity, we do have some concerns, and it starts with a sort of what we think is a puzzling result. Insurers want to sell their life insurance and annuity blocks because of low profitability and high capital requirements. Yet somehow private equity, which demands a higher return on capital than insurers have historically required, are buying this business. So I would say that in addition to issues that have recently been identified by the NAIC, and those are private equity owners more interested in assets under management and related fees than profitability of the life insurer, use of reinsurance to avoid capital requirements, and lack of adequate supervision over affiliated business arrangements, we have two other concerns. One is the growing demand here in the States to adopt insurance business transfer laws that permit insurers to sell blocks of business they no longer deem profitable, typically to a private equity controlled firm. These insurance business transfer laws ignore consumer property rights and force a consumer who purchased a product from their selected insurer who is still operating to some other insurer that they've never heard of. Imagine that you bought a Volkswagen and after a year or two, Volkswagen sold the warranty and maintenance to Acme Private Equity Company for all the remaining warranty and service to be handled. In the US, nothing like that would ever be contemplated or considered. And yet when it comes to your life insurance property, it somehow can be given away or transferred without the consumer's acceptance. The second issue is the incentive for private equity firms to increase sales to bring more assets under management. And this is where the regulatory failures regarding life and annuity illustrations and sales practices become even more dangerous as firms vie for more and more sales through inflated and deceptive illustrations of accumulation values. So both of these issues, we think, or actually all of them, really demand sort of different supervisory analyses and supervisory techniques that have historically been the focus of life insurance supervision. Thank you.
Thank you very much, Bernie. And I noted down a very thought-provoking question from your side. How is it possible that when life insurance portfolios are sold by insurers that we feel or we see that there is a willingness of private equity to take over these portfolios? So prompting the question, what is the secret? Now, Frank, to have the supervisory view on this phenomenon of increased private equity ownership of usually traditional life insurance business, How do you assess this, and what do you feel could be the supervisory response?
Yeah, I think that's an important question to a supervisor, because our main goal is to protect the interest of policyholders, and we have to make sure that promises given by insurers are met in the future, and no matter who is the owner of the company. So we have to distinguish between selling a company to a might be private equity investor, or selling just a block of business to another insurance company which is owned by might be a private equity company. There are two different topics, but the idea is the same. We have to protect the interests of the policy holders. And it's a matter of fact that also in Germany, we are observing that life insurance policies with high guarantees are losing their appeal for insurers and their shareholders. And that's the reason why a lot of companies are knocking on our doors. The run-off platforms are knocking on our doors for German business. Having said that, the protection of policyholder is our main goal. I have to add that by law, there is a clear clause in the law that no policyholder may be treated worse with the new owner or the new company than compared to the status quo. And that is valid for each and every customer, And that is very complicated to prove. It's not a simple task. As I said, many knock on our doors, but so far only a limited number of transactions have taken place. Run-off platforms may be owned by or financed by private equity firms. Michael has a different expression. And the problem is that normally the time horizon of a normal private equity involvement is not a very long time horizon. And I think that is per se an issue we have to solve, and Mike elaborated on that. We need a long-term perspective, and handing over portfolio to the next investor is subject to the same rigorous process mentioned above. So that means it's not so easy for private equity funds to get rid of the portfolio they just acquired. And so far, I think short-term orientation is the wrong starting point for private equity investors. For me, a wish to this industry would be investors such as private equity firms. They may also want to look at less well-capitalized firms in order to add value to the market. I think from a supervisory point of view, I'm not very much interested in seeing transactions where portfolios are moved away from very well capitalized insurance groups to a private equity company. There we are very careful. The private equity investors in the run-off platforms could really bring added value to the market when their targets are less well capitalized companies. Yeah, I think I stop here. Reinsurance is a different issue. Transferring it to reinsurance, there we have to be very careful. That is not a kind of supervisory arbitrage, but that is very important for us as BaFin, at least here in Germany. Thank you.
Thank you. Sorry. Thank you very much, Frank. Sorry, I was double muted. I've taken notes. I mean, I fully see your view on, in the end, for us, the main interest as a supervisor is the interest of policyholder, which should be protected, and linked to that, of course, also the importance of a long-term perspective of whoever takes over an insurance portfolio. Now, before moving to Michael, I would ask whether we could see in the meanwhile the results of our last polling question. So I'm just going to give the secretariat, here it is already. So here we see a small majority saying, well, we do expect private equity participation to increase the focus on efficiency and capital optimization in the insurance industry. And there is around a bit more than 1/3 of our audience that does feel that this could also lead to an increased investment allocation to riskier assets. Now, Michael, you've mentioned it already before. I suspect there should also be benefits for insurers from an increased involvement of private equity. So do you see any of these benefits? And maybe a question also linked to that, how do you believe that policyholder protection can be warranted? How could we avoid possible conflicts of interest between, on the one hand, the owners of the private equity firm and the policyholders themselves? So I would very much appreciate your views on these aspects.
Thanks, Dieter. Let me associate myself or support the comments that Frank made. I think his concerns are concerns that I would share, and that many in the space that in the private capital space would also share. I think importantly, supervisors need to assess all of these considerations through the change in control process. So Frank outlined that for the BaFin considerations, some of the BaFin considerations. It's certainly true in the United States and other markets as well. First of all, there are two pieces to the private capital involvement. One is on the transactional side, one is on the investment side. On the transactional side, what the private capital is helps facilitate is the exit of an insurer from old markets, entry into new markets, development of new products, allow a company, an insurer, to invest more heavily in one aspect of their existing business versus another. I do want to make the important point that these most private capital participants in the market, in the insurance space, are not looking at this as a 2 or 5 year participation. This is a long-term, multi-decade commitment to the insurance sector. It is one of those kind of happy unions where the private capital wants to support their long-duration fund offerings. So things like real estate, private credit, even infrastructure in certain jurisdictions that are beneficial to and supportive of an insurance company portfolio. That is also good for the private capital asset manager. So there is that, as I say, kind of happy union between the mission of the insurance company with long dated liability and the mission of the asset manager that has a long dated asset platform. So on the transactional side, again, kind of a happy union between long liabilities, long duration assets. On the investment side, I think it's really important, and there are myriad data points that I won't get into, but private credit in the United States, commercial and industrial loans have shifted to non-bank institutions dramatically over the last 15 or 20 years, all sorts of reasons why that's the case. And data shows that, frankly, that those commercial and industrial loans through non-banks perform better, outperform the commercial and industrial loans that are provided by the banks. So the managing of assets through private capital providers, or the alternative, what I call the alternative asset managers, this is a win-win really for insurers with long-dated liabilities and for the asset managers. It's, again, a happy union that we can expect to see in the years going forward. Now, to the final thought in reply to your question, Dieter, and you were asking about policyholder protection. Absolutely essential, and the seminal concern, regardless of who's acquiring a company or a block of business or what the nature of a portfolio construction is. So a couple quick thoughts. We've talked about capital management at the insurer, essential. Asset liability matching, essential. Supervisors have key roles in ensuring both of those are adequately, sufficiently, and rigorously managed at the insurance company level. Few key items. One, the capital that is funding an insurance company acquisition or a block acquisition, we want to be sure that's long duration, if not perpetual capital. No short-termism, to follow on Frank's comment to a similar effect. We need to ensure that the insurance company has a comprehensive and robust governance program from its board of directors down through its chief investment officer and that team to ensure there is robust oversight of the investment portfolio, investment decisions, strategic allocations, that all of that is done in the interest of the policyholders. We need to be mindful that investment portfolios at an insurance company are for the benefit of the insurance company and not potentially an asset manager. We want the CIO team, the chief investment officer team, plugged into all aspects of the insurance company capital management, product development, risk management. And then one additional key point, affiliated transactions, where there are investments in affiliates of the capital provider, the private capital that may have an ownership interest. We want to be sure those affiliate transactions are shared with the supervisor, that the supervisor is comfortable at every step of that investment process, that those investment decisions are made for the benefit of policyholders. And then lastly, and most fundamentally, the relationship between the insurance company and the supervisor needs to be 100% transparent and forthcoming with respect to all aspects of its operations, of course, capital management, but also on the investment portfolio side. And I would hope for frequent engagement, reporting from the insurance company to the supervisor about the performance of the investment portfolio, the allocation, compliance with investment guidelines, all of those things that are essential for insurance company operations. Dieter, I'll stop there, but needless to say, a lot more that I could add to in response to your question.
Thank you very much, Michael. I mean, I've noted your elements on, I mean, the positive effects this may have of private equity ownership on helping insurers to exit from certain markets, how this could lead, if well managed, to a win-win situation in terms of asset management, while of course at the same time not losing track of key elements such as capital management and asset liability management. Thank you for that. Now, to a last question in this round of panel discussions, Stefan, maybe for you, we also saw in the audience poll that at least a bit more than 1/3 of our audience felt that increased private equity ownership could also lead to changing investment behavior on behalf of the insurers. So my question for you is, what risk do you see for insurers in their changing investment behavior? Do you see an increased investment, for instance, in non-traditional assets, a shift to higher yield fixed income securities? And what could that bring in terms of risk for insurers?
Sure, thank you. So, just to take a step back, where does risk come from within the investment portfolio? It comes from credit, it comes from duration, and it comes from liquidity, right? Insurers also have to manage the volatility of valuations over a period of time. So, what do we see in the market? Across the market right now, including the onset of more and more PE ownership, we don't see a dramatic increase in overall investment risk. And as a result, we don't expect to see a period of increased write-offs or write-downs as a result. We feel that the market is taking a measured approach. Is investment risk increasing? It is, but again, it's increasing in a measured way. It's clearly got implications for risk-adjusted capitalization through our capital model that we apply to all of the rated life companies that we follow. But really what we're seeing in terms of that increased allocation to alternative investments, in many cases increased allocations to less liquid investment classes, whether it be infrastructure, private placement, private debt, hedge funds, commercial real estate. You know, these are these are opportunities. I think Michael mentioned it. There are a lot more opportunities in the private markets today than there were years ago, and there is less liquidity inherent in some of those asset classes. But again, I think that dovetails well for for matching a life portfolio of liabilities, right? These are long dated liabilities with very minimal amount of kind of shock potential, very different than the non-life portfolio where you could have a call on capital after a catastrophic event, for example. So adding some additional illiquidity into the portfolio to improve yields in a measured way, we think makes good sense. Many organizations are also increasing their allocation to cash to offset this aspect of increased illiquidity in the portfolio. So, you know, overall, we do feel that it's not something that's jeopardizing the capitalization of these organizations, and certainly something we would be monitoring because, you know, one point maybe to kind of build on something Bernie said with this model could be a bit counterintuitive. How does a PE company generate the yields and the returns that they need to satisfy their investors? You know, it's you know, in all likelihood being done by taking increased investment risk. And I would argue that this model hasn't truly been tested yet, right? They might say that COVID, you know, first quarter, second quarter of 2020, we saw that financial market shock, but as we know, it was very short-lived. So, you know, I'm not saying that this model isn't resilient enough to withstand a proper long-term kind of down credit cycle, but I don't feel it's been thoroughly tested yet. You know, the last point that I would make on this is I think it's important to remember as supervisors and even in our role at AM Best, you know, being a bit of a barrier to entry, looking at these business models and providing ratings to the ones that, you know, deserve a good rating is the resource that's needed to monitor and react quickly to a more kind of diversified alternative investment strategy, right? It is labor intensive. It requires strong dynamic hedging platforms and the ability to shift the investment portfolio very quickly.
Thank you very much, Stefan, for this perspective. Indeed, risks, but at least, and that corresponds, I think, also to what we've noticed in scope of the global monitoring exercise. So far, no dramatic increase indeed of investment risk. And where there is risk, there is also opportunities, as you mentioned, maybe for insurers to go and see if there are any opportunities on the asset side to fit well their usually illiquid liability portfolio. Indeed, thank you for that. Now, allow me to move on immediately to the last part of our panel discussion in the interest of time, because I see it's ticking away, unfortunately. Let's have a few words on some of the emerging risks we see these days. We've mentioned in our global monitoring exercise risks such as cyber and climate risk. And Stefan, allow me to get back to you immediately on this. What risks do you see for insurers moving into underwriting of cyber insurance, for instance? How about the non-affirmative silent coverages? Should we be concerned about this or not?
Yeah, thank you. We could spend a lot more time than we have talking about emerging risks and certainly talking about the underwriting of cyber exposures. It's a very interesting line of business. As we know, it's seen rapid growth and it's really building scale in the market. And so there are opportunities with regard to cyber, but as you note, there are certainly challenges. And you know, one of the things that we're seeing is in terms of the conversations we're having with rated companies on the non-life side that are underwriting this business is the experience data is really not there to the extent that it is across other lines of business. So the data utilized by actuaries for pricing the products, reserving the products, you know, you really just don't have that rich database of experience to set what you could be confident is an appropriate pricing. And then on the reserving side, as we know, certain cyber attacks, whether it's a data protection issue, they can materialize. Those cyber attacks can take place in some cases 6-12 months before the victim is even aware of it. So there are some certain reserving challenges around the timing of the loss taking place and then the policyholder becoming aware of it. But I would say that, I mentioned that we've had very significant growth in this market. Most of that is through rate increases because the rates prior to COVID, prior to this remote work environment, were very soft. And as a result of heightened loss experience over the last 12 to 18 months, we've seen a real surge in rate, and that's been truly needed. But I think before we're going to see more capacity enter the market, we've got to solve for the catastrophe exposure, kind of the aggregation of cyber exposures that companies that are underwriting this line of business have to contend with. Modeling around cyber catastrophes is there. It's improving, and it is a valuable tool, a valuable input, but there's by no means the same sort of maturity that you have for the natural catastrophe models. So I think rightly so, insurers and reinsurers are being quite cautious in terms of how much aggregate limit they want to put out there until the modeling becomes more robust. And, of course, another challenge with regard to cyber that's somewhat unique is the loss wouldn't be necessarily contained to a geographic area like you would have with a hurricane or an earthquake. So there's a lot of challenges. It's I think a positive for the industry that overall the broader economy realizes there's a need for cyber protection. It's absolutely a conversation in board meetings across all different sectors of the economy, all different industries. And one of the last points I would make would be to what you mentioned around silent cyber and kind of that coverage embedded in a package policy. One thing that we are seeing is companies that are offering this business, and even those that are not, that are writing commercial business, really are looking into their policy language and making sure they're getting their arms around how much perhaps inadvertent cyber coverage they're offering through that silent cyber and introducing sublimits, et cetera.
Thank you very much, Stefan. So I noted the need or the requests of many parties in terms of cyber protection and a role that insurers can take on that. Of course, providing what you've mentioned. Think about which rate to put. Is there a need for rate increases, for instance? Think about, or there is maybe need for progress in terms of being able to model cyber risk, and watch out, of course, for silent cyber. Now, allow me to move to Bernie. A question on Bernie related to these, let's call them new and emerging risks. Do you have any concerns, Bernie, in terms of what protection gaps may arise in terms of cyber and climate risks, in terms of or in view of policyholders and consumers? And do you see maybe any potential solutions in case these protection gaps would arise?
Thank you. So in terms of cyber, the personal cyber insurance market is pretty limited right now. But in terms of sort of the broader issue, I think that cyber overlaps with pandemic and terrorism issues. In the US, we have a federal terrorism reinsurance program, which is triggered by a terrorist act. But what if a terrorist act was to start a pandemic? Or what if the terrorist act was based on a cyber attack? So, we have a set of issues that really transcend traditional insurance types of products and coverages that require a sort of a public-private partnership to manage what can be truly mega catastrophes that are beyond the scale of the private insurance market. So the other aspect about cyber that's of concern is whether the purchasers of cyber insurance know what they need and what they're actually getting. You know, when you say, I'm getting cyber insurance, I would imagine that 10 different companies are going to tell you 10 different things that they expect to be covered for. So it's definitely an emerging market, and the companies are rightfully careful, the insurers are rightfully careful to sort of tailor the coverages to things that they can actually support, but while providing some meaningful benefit to consumers. On the climate, I guess that's a topic that is going to be discussed in many forms, but the one issue that I would raise on that is our concern about the disproportionate impacts of climate change on communities of color and traditionally underserved communities. In the US, there are definitely communities that have far greater trouble accessing essential insurance products, whether that's auto insurance or home insurance. So our concern is that the impacts of climate change disproportionately create risks and exacerbate risks in historically underserved communities. And as a result, insurers' responses could disproportionately affect the availability and affordability of insurance in those areas. So our main plea on that is that insurers engage in loss mitigation partnerships with policyholders as a way to address some of the climate change issues. And I wanted to just finish by touching on what I thought was one of the lessons of the financial crisis and the critical role of sort of market conduct supervision for supervisors as you think about these emerging trends and low interest rate risks. One of the lessons of the financial crisis was that inadequate oversight of mortgage sale practices contributed to unsustainable sales and a housing bubble. And many market participants contributed to these bad practices, including private mortgage insurers, credit rating agencies, and investment banks. And in the US, the federal regulators failed to rein in these fraudulent loan practices, even encouraging so-called new innovative loans that contributed to the fraud. And we see some disturbing parallels today. We see investment banks designing custom indexes in partnerships with insurers to maximize illustrated values, but we don't see regulators taking the steps necessary to rein in these unrealistic illustrations. And we see a massive increase in the use of derivatives by insurers to provide the index promises, creating the same type of risk concentration we saw with AIG selling far more credit default swaps than they could pay. So from our perspective, the critical lesson is that supervision of sound market conduct, product sales practices, is a critical component of ensuring financial stability. Focusing on financial supervision issues alone, capital management, asset liability management, is not sufficient. Pure risk models did not necessarily capture the type of conduct risk that threaten financial security. So if there's one message I'd like folks to take away today, it's that financial stability requires really strong supervision of market conduct as much as it does financial conduct. Thank you.
Thank you, Bernie. I'm just repeating your final message. Indeed, financial stability supervision should not forget to also look at conduct-related risks. Now, as to my last question in this panel, Frank, any supervisory view on cyber and climate, which we both know are emerging risks for insurers, also new for us as supervisors, I would say. As a supervisor, what risks would you focus on, and what data are you looking at to monitor this risk? Because I can imagine this is quite challenging, right?
data is an issue, and we do not have sufficient data, which is clear. To start with cyber and cyber policies, we made an analysis about cyber, silent cyber risks 2 years ago, and I can only agree with what Stefan, I think, said. The silent cyber risks seems to be well managed, and so that is not too big concern for us. As far as cyber policies, I think I'm very happy that the industry is very cautious. There's a kind of protection gap, but the demand is there. But I think due to missing data from claims experiences, from incidents, etc., we have to build up databases about the incidents. There is some development there, but up to now we don't have a sufficient knowledge. The accumulation risk in cyber risk underwriting, I think, or the aggregation risk, I think it's huge, and that you cannot compare with other normal risks. And insofar, I think it's good that the appetite is limited. I think there is no policy available in the market, even not for a consortium, to really ensure the full necessity, full need for an industrial customer. I think there is a certain limit, and the limits are too small to cover really the risks. And I think that's good. Insofar, I agree that has something in parallel with risks which are cannot only be bared by the industry. Indeed, I see also a parallel to terror, to pandemic and cyber, and perhaps even for NatCat catastrophes. If you see what we had in Germany here, and then I will stop. What we had in Germany this summer, the flood was a disaster, and we have only 46% of German houses insured by this type of insurance. And it needs much more energy, and perhaps the state has to help in a certain form, I cannot define yet, to increase coverage there. And that might be similar in these other topics, cyber, pandemic, and terror. I will stop here in the interest of time, sorry.
Okay, thank you very much, Frank. And in the interest of time, I unfortunately have to also close this panel discussion, which also means, and I'm very unfortunate about that we don't have any time left actually to answer any audience questions. So the only thing I can hope for the audience is that the debate that we've all heard today answers at least some of the questions that you had before we went into the panel. I mean, if allow me to summarize a little bit as follows. We've discussed about the low interest rate environment, which we know is already there for a few years, and if it were to continue, the challenges at least don't seem new. We know that the low interest rate environment does bring challenges for the viability of the traditional life insurance business. We have seen how we were moving away from guarantees. I think it was also Bernie who explicitly mentioned that. We have talked about an effect of the low interest rate environment being a search for yield. I like to repeat the words of Frank. Let's make a distinction between what could be reasonable and unreasonable in terms of search for yields for insurers. I take over also what Stefan has mentioned in terms of at least what we've seen so far is not an excessive search for yield. Let us also hope that there is one possible future path where there is a gradual reversal of interest rates. But as mentioned by Frank, watch out, at least from a supervisory perspective, we shouldn't hope too much. On private equity ownership, we've talked about the risks. We've also talked about the opportunities this may bring. I like to quote Michael here, in terms of asset management, there could be a win-win. So let's not only focus on what is dangerous or risky about private equity ownership. And actually, I think we can say the same about these new emerging risks such as cyber and climate risk. where in case of a protection gap, there are also opportunities for insurers to help find for solutions and let's say make sure that at the level of society, some of these risks we face due to the floodings, Frank has mentioned them, and unfortunately in Belgium we've experienced those floodings as well in July. There is debate coming up on which role insurers could play to help us overcome these challenges. I would like to thank my panelists for joining me today. I hope you all found it an interesting and stimulating discussion. I can say the same for the audience. I hope that we've brought some added value to your afternoon or morning, wherever you are, or evening even. And thank you very much for joining us today, and I hope to see or hear you again in the near future. Thank you very much.